Hey traders, support and resistance are the backbone of successful trading. 90% of traders still struggle to make use of this strategy because they don't understand support and resistance level, let alone use them to their advantage. But don't worry, because by the end of this video, you have a solid knowledge on how to leverage support and resistance to improve your trading journey. Today, I'm going to share and guide you through mastering this essential concept. If this is something you're interested in, make sure you watch the whole video through. So, let's get started. What is support and resistance? Support and resistance are not just lines on a chart. They are the hidden levels and areas where the big players make their move, and today we're going to show you how to play their game. Okay, I'm going to make this as simple as possible. Support is like floor. It's a price level where buying interest is strong enough to prevent the price from falling further. Resistance is like ceiling. It's a price level where selling interest is strong enough to prevent the price from rising further. Support in trading occurs when the price falls to a support level, triggering buying interest that pushes the price higher. Buyers will step in, pushing the price back up. This level can act as the floor for the price, preventing it from falling further. Resistance, on the other hand, is when price is rising, hits a certain level, attracting sellers who push the price back down. This level can act as a ceiling for the price, preventing it from rising further. That is all you have to know. It's very simple. Support is like a floor for the price, letting buyers come in to hold the price from falling further, and resistance is the ceiling for the price, letting sellers come in to push the price down. Support level is where you'll be looking to buy, and resistance level is where you'll be looking to sell. Now let's move on to type of SNR levels. There's 3 types of SNR levels that you should know. The first one would be strong key level, second is weak key levels, and the third one would be flip key levels. A strong key level is when price touches a level more than 4 times, showing a strong rejection and respect for that level. The more rejection, the stronger the area of interest, and the higher the likelihood of a successful trade. Let's take a look at the example. Okay, now we're going to take a look at the strong support zone. Why I said that this was a strong support zone was because you can see here that price managed to touch 4 times in this zone. Yep. So 1, 2, 3, 4, and every time it touches the zone, it bounces back up. Every time it touches the zone, it bounces back up. So this repetition creates a strong support area. So when the price approaches the zone again, it might be a good opportunity to consider a buy. Why? Because the price has bounced back up from this level 4 times, increasing the odds of it happening again, especially if the overall trend is upwards. Okay, now let's take a look at the strong resistance zone. Why did I say that this is strong resistance zone? It was because price managed to touch the zone 4 times. Okay, 3, and the last one 4. If you can see here, every single time the price touches the zone, it managed to go back down. Okay, so here we can see that the price hit this level 4 times. This repeated touches creates a strong resistance area. So when the price approaches the zone again, it might be a good opportunity to consider a sell order. Why? Because the price has been rejected at this level 4 times, increasing the odds of it happening again. So especially if the overall trend is bearish. Now let's take a look at the weak key levels. Okay, so now we can see here on this chart, this is what I would consider a weak key levels of support. That is because you can see there's only 2 touches here, the second one, and you can see on here that price managed to break through our support area. okay, and then continue bearish from there. Why? It's because price did not respect this zone. That is why we need to make sure that our support zone and resistance zone is strong and not weak. This is what I would consider weak, is when price does not respect this zone and then manage to break through and continue to push the price downwards. The last one, we call this as flip key levels. Okay, flip key level is basically when our support area, price break through that support area and turn into our resistance. Okay, and another one would be a resistance area, price break through to the upside and become our new support area. This zone is really important because when you are able to detect this, automatically you're able to find out the strong support and resistance area. Now let's take a look at an example of a support become resistant. And here I can see one. And the reason why I said this is our support become resistant is because, as you can see on this side, is our support. Price did not manage to break through to the downside. It's a strong support here, multiple rejection. And then price managed to break through this area and managed to respect this level and turn this into our resistance. Okay, now let's take a look at the example of RBS. So I can see there's one here. The reason why I marked this is because we can see there's a rejection of resistance right here, and then price managed to break through that resistance level, and then it did a pullback and continue moving upwards. You can see right here, and then price did a breakthrough and then pull back to that zone again, creating our new support, and then just manage to go up. So this is resistance becomes support. All right, so now we know what is support and resistance, how do we draw support and resistance, and type of support and resistance levels. So now, why is it important? Why are support and resistance area important? These areas are important for traders to master because they represent potential price reversal zone, okay, and they are also like invisible barriers that guide price movement and can accelerate your trades towards profit target. Now let's take a look at the top 3 mistakes you should avoid when marking your SNR levels. The first mistake is seeing SNR as lines and not zones. If you focus on exact lines, you might miss a good opportunity. Prices aren't robots and don't always follow perfect lines. By thinking in areas, you account for these changes and have a better chance of finding entry and exit points. The second mistake is jumping in without a plan. Without a plan, you might make a quick decision based on emotions, which can be risky. And the last mistake would be chart clutter overload. Okay, so having your charts too busy with SNR lines, you just gotta simplify your charts by focusing on only the most important SNR zones based on your time frame and your trading style. That's it for today, guys. If you're interested in learning more about simple and effective trading strategy, click the link in the description. In my community, you can connect with other traders to share knowledge and experience. Thank you for watching. If you enjoyed this video, please like, comment, and subscribe for more content. Remember, knowledge is power in the market. See you guys in the next chapter. Bye.